Well, the happiest place on earth isn't looking so happy right now. Disney just announced that they are letting go of 7,000 people globally. That is a 3% of the company. Bob Iger, the returning Disney CEO, has previously stated he will be doing everything it takes to get Disney back into action. Iger said, quote, "The move was necessary to address the challenges we're facing today." The layoffs announcement came minutes after its quarterly earnings were posted, which revealed strong growth in Disney theme parks, but a sluggish period for its TV and direct-to-consumer streaming services. This seems to be a trend in the streaming industry, as Warner Brothers and Netflix have both made job cuts in the last 12 months as they struggled to remain profitable amidst a hardening economic climate. This prompted Disney to restructure in order to cut costs that would total $5.5 billion. $3 billion of that is from content alone. This is despite Disney Plus adding 12.1 million subscribers during the fourth quarter of fiscal year 2022. That's a total of nearly 57 million subscribers added for a total of 235 million subscribers. That's a lot. Despite the subscriber numbers and the level of growth Disney Plus has seen, the direct-to-consumer or DTC division reported a $1.5 billion loss for the quarter. Apparently, the original content Disney Plus created cost the company a lot of money. Bob Chapek, who was the CEO at the time, was quoted in an earnings call as saying, quote, "It's all about content, content, content. We are bullish about our future content going forward, not only in terms of quality, but also in terms of quantity. And that's really what's driving our bullishness for what we might see as the pricing power that we would have going forward," he said. Disney supposedly reached its goal to premiere one new title per week. Quality content is expensive. They had to increase their spending. Not only that, higher marketing costs for Disney Plus have also played a role. They won't gain new subscribers unless they market. During fiscal year 2022, Disney direct-to-consumer division reported $840 million in other operating expenses and $1.3 billion in sales, general, and administration expenses. Disney also had to deal with a penalty to end a customer licensing agreement to be able to bring some content over to the streaming platform, though just how much of the company lost because of this is unclear. Disney also shared that in fiscal year 2022, the average monthly revenue per paid subscriber for domestic Disney Plus decreased from $6.62 to $6.27 due to a higher mix of subscribers to multi-product offerings. These multi-product offerings often have Disney Plus included at a cheaper price as part of a bundle, reducing how much money Disney makes from each subscriber. As if all these problems are not enough, Florida Governor Ron DeSantis also managed to restrict the autonomy of Disney in Florida and strip some perks enjoyed by the company for over 56 years. These changes make it possible to impose taxes on Disney to help fund road improvements outside Disney World's boundaries. It also eliminates some Disney World exemptions from state regulatory review, which could cause the cost of building projects at the resort to balloon. Disney has been down for the last 6 months and will most likely continue to lose money for months to come. Iger said, quote, "Our current forecasts indicate Disney Plus will hit profitability by the end of fiscal year 2024, and achieving that remains our goal." Both Netflix and Disney have introduced ad-supported channels in the last few months to entice new and returning customers, but whether or not this and cost-cutting are enough to bring Disney back to life by 2024 is hopeful at best. What do you think will happen to Disney? What do you think they should do to get back into fighting form? Leave your thoughts in the comments section below. This has been Ivory Hecker for Noble Gold News. Don't forget to like, subscribe, and hit notification button. Also follow us on Instagram, Twitter, and Facebook.